The new year saw almost right on the dot as we turned the page on that calendar, a reversal of that manic move that we saw in December. Well, two things there. Do you think markets overshot the target in December? And do you see this cross-asset move correction as we continue?
So I think if you look at the technical indicators for equity markets, some of them are looking a bit more stretched. So some near-term consolidation probably expected just given the speed of the move up. But we do think this year, when we look at equities, we do think it's supported both by a moderating growth, but not really a recession. We think very limited risk of that. But also the fact central banks are shifting to a rate cutting cycle. We think that easing of financial conditions should be supportive of our asset market.
Okay, so let's pick up on equities. When you say equities, that's a big word. Where in the equity complex do you want to be?
So we have always done some global equities, but within equities, we have a preference for U.S. large cap as well as Japan at the moment.
Okay, so Japan. So, and you mentioned rate cuts, the duration. Do I want that right now? Do I buy this dip in treasuries, for example?
Yeah, actually, we think that at current levels, still pretty attractive if you think that we're actually getting into the rate cutting cycle. Clearly that before the rate cuts actually happen, we think that there is probably a range trade right now, but it could move lower once we see the rate cuts coming through.
Right, and what is your working assumption on the number of rate cuts we see? Because it's now 6 over 12 months. That seems aggressive or not?
Yeah, it seems a bit aggressive to us. Our base case is about 4 cuts this year, probably start somewhere in the middle of the year. We think the recent commentary from the Fed, especially the minutes this week, probably push back against a very early cut this year.
Okay, and credit? Where do you want to be? High yield, U.S., Asia, for example. Asia, you have some supply issues here, of course, but in the U.S. things look expensive.
Yeah,
right?
So if we look at across the credit complex, we still have a preference for U.S. credit, and especially in high yield. We do think in the environment we do not see recession, that carry trade still makes sense.
Okay, biggest risk to your view? What might change your mind?
If we do have a recession, I guess that will be a big change in terms of how we're looking at the asset market. But that overweight to duration still provides you that hedge. Okay.
We need to ask you about China. This market's been cheap for a long time, so that's not new news. Have you gotten more queries on this market? I mean, is cheap enough to attract buyers back in?
I think we're probably at that point, and especially when we saw more policy easing coming through kind of late October, November time, we did get more questions about the policy trajectory. We think that's key to the growth momentum this year. And given the light positioning as well as low valuations, we think there is room for it to rally from here.
Okay. Anything else we're missing in terms of, so you mentioned risks, so recession. Geopolitics has come back as well. Earnings, is that a big risk? Anything else that we're sleeping on as we look at 2024?
I guess the other risk from a macro perspective is just whether the disinflation would continue. And if we still have a relatively okay growth environment, is that enough to really see inflation going back to target? Okay,
what do you think about cash? I know that's out of left field, but a lot of people have told us going into this year, the cash strategies that worked last year probably don't do that this year, but rates are still relatively high on the short end, at least over short term.
Yeah, they're high, but they're gonna go down, right? So we are underweight. We are underweight cash at the moment. We think all the other asset classes look more attractive.